Capital exclusive analysis. In today's video, we're discussing oil, WTI crude. Many tickers to look at oil, but we're looking at WTI crude cash contracts here. Currently trading at 77.21 a barrel. Now, obviously, everyone knows the CPI headline came out, came in hot, sent markets selling to the downside, stocks tumbling, bonds tumbling, commodities tumbling. But oil didn't tumble. Oil actually eked out a nice 0.74% gain on the daily chart session as observed by this candle. It was actually up quite substantially, testing $78 a barrel, but markets are too weak and the dollar was too strong. It was still super impressive to see that the oil market rallied higher despite the technical breakout on the dollar. So, I mean, that's very, very impressive to see. And that's a problem for inflation because if the dollar is shrugging, if oil's shrugging off a stronger dollar, that is a recipe for more inflation. And what's interesting is when you look at, I prepared my members for this hot CPI report. I said, okay, there's way too much of a move to the high side in oil for the inflation not to uptick. And take a look at why. If you look at, and you have to remember, the CPI is always 1 month delayed. So really the data that we got for this February CPI is really January's data, January CPI. So we have to look at what happened, what transpired at the start of January in oil. Basically, oil started trading down here roughly around $7.40 in the month of January, and it closed the month of January all the way up to about $75.70 a barrel, $75.70 a barrel. That replicated about a 7.49% move. I mean, there was actually about a 9.5% move when you factor in the high reversal and the low and you just do a little bit of a mean reversion calculation. But oil, to sum things up, closed the month from the low, opening low, to the opening high around 7.5% to the high side. So naturally, when you know this, it's going to affect the inflation. And when you look at things from a deeper perspective and how the CPI is calculated on a year-over-year basis, you're really comparing the numbers from January 2023. And in the month of January 2023 here, oil had roughly a 1.86% decline from the opening high to the closing low. You know, there's a lot of bit of chop in between where it actually dipped below, dipped above. So, but net, it finished down 1.86% on the month. So that was more deflationary, which is why you saw the CPI compressing so drastically. But as we reach a point here, again, you saw the next month in 2023 decline, slight rise, bigger decline. As we start comparing oil in this range to this type of price action, the euro numbers start to really get skewed and not in favor for the inflation rate. Since oil is starting to move up and really test these ranges by these year-over-year comps, that's not a positive thing for the headline number. And that means that if oil continues to grind, the energy side of the CPI is going to remain sticky and heavy. And it's likely going to mean inflation is going to push up. Now, let me be clear. I mean, there's some bullish patterns here on oil that are temporarily at play. Full disclosure, I am long some oil stocks with members, and I do think that there's going to be more higher price action in oil. If there's a scenario that oil breaks out of this little neckline here, you can see it would have a much rather inverse head and shoulders, a very large head and shoulders. You've already targeted and triggered one inverse head and shoulders, which takes you to about 84. But if you trigger this mega one, we're talking about a big move in oil from this neckline. That would roughly mean a $89, $90 retest. You would retest this previous little neckline that you broke down at. So that is pretty crazy to think that oil has the ability, if it breaks out of this $79 zone, to push all the way up to about $90 on the charts. That would mean inflation is rip and roaring with a vengeance. So definitely interested in seeing how oil reacts here. You did have energy stocks under a little bit of pressure today with the sell-off, but they held up okay. You know, XOM still holding this key trend line, just consolidating in a nice bullish flag pattern, and so it appears to be. XLE was hit, but it wasn't hit as hard as some of the other sectors, still forming a nice bull flag pattern, also a potential inverse head and shoulders. So I'm still waiting for a long-term breakout here in the energy stocks. I do think we get them. You can see on the XLE, major pivot, 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 and you're now starting to put in a weekly bull flag pattern off of this support level. So I think energy is looking strong, and this means that inflation is also looking strong. If energy starts to move up, that's a recipe for disaster for, I believe, small caps, transport stocks, and a lot of the riskier high beta tech names that have seen lofty lofty valuations. I don't think it's in many playbooks for inflation to keep rearing its ugly head in 2024, and that's certainly what the dollar is showing us here. You know, the dollar has been stair-stepping this bull flag breakout. And what type of consolidation we get here at resistance is going to be key to dictate how long it takes us to achieve upside target 1 and target 2. And once we check those targets, once we clear those targets, I mean, you still have a lot of potential higher room that the dollar can run, since we are trying to break out of this little bit of a flat bottom wedge pattern. On that note, take care, everybody. Please give this video a like down below. And if you're interested in to see how I'm trading these commodities, these energy markets, definitely check out my website at tradingcapital.ca. Take care, everybody.